So there are pockets like that. We've found places in healthcare. There have been certain situations or opportunities in the manufacturing space, both the industrial manufacturing as well as consumer manufacturing, consumer electronics manufacturing. So those are the kind of spaces that we have probably been able to identify ideas in the last 3 to 6 months. They've done well. I mean,
Tahir, we're coming back to you.
Yeah, we'll just come back. Sorry, we'll just come back to you in a minute. We have the market opening, so just had to focus on that very briefly, and then we'll head back to you. For now, the first tick on the index is very quiet, absolutely flat. The mid-caps as well not doing too much. The bank nifty is down about 50-odd points, so just consolidating. And it's not a bad outcome, given that we have higher crude prices. The market is holding up at that 19,570 mark. So looks like the bullish trend is something that does continue. ONGC, Cipla, Power Grid, Hero MotoCorp, Ultratech Cement are some of your big gainers in trade today. I mean, by big, I mean around 0.5% to 1% rally at the max is what you're seeing. ITC, Wipro, by the way, fresh 52-week high over there, so keep an eye out on that. HCL Tech is also at a fresh 52-week high. What's dragging the markets today is Asian Paints, Hindalco, Nestle, Bajaj Finance, and some of the banks. Indices and ICICI Bank under a bit of pressure, down about 0.5% to about 1% on some of these names. So suffice to say that, by the way, the market breadth is quite strong at 1,900 stocks on the advancing side and lots of stocks in the broader markets, whether it's something like a Dish TV, Sri Renuka, NBCC has seen that order win, so looking pretty good over there. Those are all in the news, but otherwise, the market for now is very quiet. It's the IT index that is once again outperforming. The Nifty IT index is at a fresh 52-week high. The pharma index is also doing well, up almost 0.3%. And there are plenty of stocks that are hitting fresh highs. Nazara Tech, once again, is up about 2%, so keep an eye out on that. Bharat Forge is at a fresh 52-week high. Strong order wins there. North American truck orders, that is. PVR Inox is at a fresh 52-week high. Oberoi Realty as well. So lots of stocks, but otherwise the market is just consolidating, which is not a bad thing given the kind of cues we had.
Well, that's right, Sonia. NBCC, just take a look at that stock. It's up close to around 6%. You know, the management had joined us last week and they gave us a sneak peek that they're expecting a large order. That's come through. They've bagged a project worth 2,000 crores from the Kerala State Housing Board. So that one's up and about in today's trading session. Voltas, big underperformer, losing market share. They've been losing out on margins as well. Well, now they're talking up the market. And Motilal Oswal as well came out with the note. They're pretty positive on the stock. So they're looking to regain that lost market share. The stock is up close to around 2.5%. The oil-related plays as well are playing out. You have Oil India that's up close to around 2%. And on the flip side, some of these, crude-linked companies on the negative side, paint companies, for example, Asian Paints, Sonia mentioned, Berger Paints is down close to 100%. Apollo Tyres as well is down close to around 1.5%. So both of them taking a bit of a knock in today's trading session. Vedanta, some relief coming in for Vedanta Resources. Maybe they can take care of themselves. Vedanta Limited shareholders will be happy if that's the case, because otherwise all the cash in the books has been basically moving back to Vedanta Resources to take care of the debt obligations. A couple of other notable movers from the broader markets are on high volumes. You have Sri Renuka that's up close to 4%. JM Financial as well is higher. And IDBI Bank as well is moving up. On the flip side, finally, IRFC is seeing some profit taking. It's down close to around 4% as we speak, as is the case with RVNL. Prashant.
Okay, well, I mean, there's a fair bit happening and, true to form, the market's kind of holding on without too much trouble, right? I mean, green on the screen, 19,500, almost 19,600 now is what we have. So just the beginning, we'll see how things go. And I must say it's a quieter start as compared to the last couple of days. The broader market would start jumping up, mostly up, not down. But this morning it's a slightly sort of more subdued kind of start. Volume-led gainers are, there are a few and I'll highlight them. But it's not as if you've got lots and lots of names which are going up and down. NBCC, Vedanta, I think you've got MMTC. MMTC's had a fantastic 3-4 days. Voltas is up about 2.5%. I think there was a brokerage call. GMR Power has been doing well last 4-5 days. IDBI has been doing very well. That's coming up with gains. Some sugar names coming up as well. I mean, actually, day before yesterday, sugar stocks all rallied significantly. And I can spot Renuka at least. Geo Financial Services is down, I think, about 2.75% or so at this point in time. Sonia?
Just a couple of more stocks, actually. You were mentioning Voltas. By the way, Torrent Pharma also continues to inch higher on the back of that, impending acquisition of Cipla. So Torrent Pharma in the green. You have a couple of more names that I'm looking at this morning. There's, of course, L&T Tech from the mid-cap IT space. By the way, IT is really surging now. So big moves there. TCS is up in the green. HCL Tech is at a fresh 52-week high. LTI, Mindtree. So, this space has really come back in a big way. Wipro as well. And that's the space to be in.
The market texture is telling you that it's a buy on dips market and this market wants to go up. Imagine having crude oil prices moving up to $90, the dollar index at the highest level in multiple months, US bond yields higher, and still the markets are flat. I'll tell you what, the bulls will take that, at least for now, provided we don't see a sharp drawdown from here. Holding steady as we speak, Prashant.
There are no bears, Nigel. It's all bulls. I think we don't need to differentiate. We just say, because, I mean, this is incredible, right? The strength has been, it's just quite something. So 1,400 higher and 450 stocks lower. And, I've been jokingly saying 0.5% small cap compounding. I think that's become 1% daily compounding. We're not saying annual compounding or monthly or quarterly, daily. So that's essentially how strong the broader market has been. So not very far from the truth, actually. We're up about 0.4% once again on the small cap index. I mean, actually, this week from Friday's start, we are up 2.5% of the small cap after last week's 4.5% gain. So, in basically what, 8 sessions, 7.5 sessions, the small cap index, right, has returned what, almost 7% or so. So that is basically the market that one is looking at. Taher Badshah, of course, is with us, and we've been talking about what's happening in the mid-cap, small-cap space. Do we have Pankaj with us as well? Pankaj Tibrewal is... Okay, I think we'll give it a minute and we'll introduce Pankaj as well into the conversation. Taher, so you were saying, right? You were saying you met a fair bit of building material companies so you're more constructive generally, right, Taher?
Yes,
Yeah. So just tell us, I mean, it's very stock. Is this also the case that some of the themes which are doing very well, they only find decent representation in smaller mid-cap companies? Is that one reason why one kind of should look at the space more favorably?
No, I don't think that is the case. I mean, as I said, Prashant, I mean, I don't want to lose sight of the economic backdrop that we are currently in, and therefore it is our job as managers of money to probably find opportunities which will be beneficiaries of this cycle. And I think genuinely you called out a few places where there is interest which is coming back, like for example some of the consumption related names, QSR pockets that we mentioned which have underperformed. There is technology which is kind of underperformed, and they could interpret that as value. The key is how to manage this without taking undue risk in your portfolios. I know that there are a good number of pockets of the market which are doing very fancy things in a very short period of time. It's up to your own risk appetite in terms of how you want to deal with those kind of names. So I think it's important, at least for us as managers of public money, to be cognizant of risk as well, and take our chances or take our bets accordingly.
Yeah. Taher, we have Pankaj Tibrewal also joining us. He's, of course, fund manager with Kotak AMC. And you'll want to hear Pankaj weigh in on the debate as well. He's on the cautious side. He's clearly on the cautious side. Pankaj, I don't know if you heard Taher weigh in. He was saying that he doesn't want to look at indices themselves because they may lead you to wrong conclusions. He's looking at the economic cycle itself and where we are in the economic cycle, and that leads him to believe that perhaps, there's more to go. He didn't say it in so many words, but I'm kind of expressing that view on his behalf. But he's constructive. That's the message. So explain to us, Pankaj, why you are kind of cautious, especially in the small caps, micro, mini caps, etc. Go on.
Good morning, Prashant. Yes, from a medium to long term, if you look at the data perspective, last 10 years, small cap has given 21% CAGR and mid caps have given 19% CAGR. And they have outperformed Nifty by a wide margin. So from a medium to long term, they continue to be wealth creating and one of the best performing across all equity classes. But our view is that cycles have become shorter and sharper. And to survive in the long term and create wealth in the long term, we need to be cognizant about the near as well as short term. And there we believe that mid and small caps, we need to be a little careful and cautious. And there are certain indicators which are pointing towards that. Number one, if you look at the earnings yield of large, mid, small, of across all profitable companies in all the three indices, they're almost trading at the same earnings yield. And for all your viewers, earning yield is nothing but 1 by P. And when you look at the earnings yield across the same segment, why to take additional risk in mid and small caps where the mortality rate is much higher than large caps? That's number one. Number two, if you look at, there's a disconnect between the profit distribution and market cap distribution right now. So mid and small caps as a percentage of, free float market cap is about 31%, nearing all-time highs. And when you look at the profit distribution, the top 100 companies of India, which are large caps, constitute 75% of profits, and mid and small cap constitutes 25% of the profits. So there seems to be some disconnect on the profit distribution versus market cap distribution as we see today. Third, if you look at the flows, has been extremely strong. And I think we need to be careful that people are looking at rear view mirror, looking at the past 3-year, 5-year, 10-year returns, and probably assuming that mid and small caps are the way to financial nirvana. But our advice is that please don't make mistakes right now, because somewhere 2017 still seems to be fresh in minds of all of us. And mistakes made in 2017 actually had repercussions in 2018 and 19. When I look at the entire space, yes, there are pockets of opportunity, but in the near term, we see that many market participants are focusing more on P&L rather than balance sheet and cash flows. And that's something which needs to be worried about. And hence, a lot of flows are coming to mid and small cap funds. In the last 6 months, more than 30,000 crores have flowed into mid and small cap funds. We have seen 1.9 million new folios being opened in small cap funds, and they are above their historical averages in terms of valuations. So yes, from a mid and long term, we continue to be positive, but there seems to be some kind of greed which is clearly visible in the near term, and one needs to be careful about it.
Got it. Absolutely. I agree completely that, there is some amount of euphoria that's kicked into the market. But Pankaj, very quickly, I mean, if you can, tell us what are the pockets that you feel one should move out of? I ask because there's so many that are doing well now, whether it's, defense, whether it's some of the power names. You have sugar that has come back in a big way. Which are the spaces that you feel are just fads at the moment, and perhaps you should book your profits if you have them?
Sonia, history always repeats itself, and we should not forget the learnings from the past. And the past cycles have suggested that what are the pockets one should avoid in this euphoric zone? One, as I mentioned, people are looking more at profit and loss account and probably not giving too much of focus on balance sheets and cash flows. I see many sectors, companies where they have not generated cash flows for a long period of time, even operating cash flow. Those stocks are trading at crazy multiples just because the narrative for the medium to long term is very strong. I think one needs to be careful about that. Second, I am seeing a lot of sectors and companies where working capital tends to be very high. But today, the order inflow is so strong that people are not worried about working capital. Third, many sectors, companies where return on capital is lower than the cost of equity. I think people are getting excited, but sustainably we have seen that these pockets should be avoided because from a wealth creation perspective, they are not the ones to bet on. So I think classic same, investment philosophy we need to follow and make sure that we don't carried away by momentum in the near term. I think right now, quality anchoring is the most important part. Rather than worrying about too much of upside, I think one should be careful about downside protection, how the portfolio will behave if there's a drawdown or a consolidation in the market for a slightly longer term. Don't forget, calendar year to date, Nifty is up 9%, Bank Nifty is up 3.5%, but whereas mid and small caps are up between 27 to 30%. And many stocks, we have seen them multiplying. Money making can't be so easy. And hence, we believe that near term, one needs to be disciplined on asset allocation.
All right, Pankaj, very valid points out there. Just want to confirm that one number, mid and small cap as a percentage of free float market cap is at 31%, but their profitability is accounting for 25%. Did we get that number right?
Absolutely. Absolutely.
All right. Okay. All right. Pankaj, I want to come back to you to ask you what you're bullish from here on, because clearly you're sounding a little bit cautious. But before that, let me go across to Taher. Taher, you're quite constructive, and we got, the spaces that you're constructive on. But where would you be a little bit cautious? And then we'll go across to Pankaj to get where he's bullish.
So in the same sector, you probably have opportunities which are not as expensive, and then there are certain stocks in the same sector which are at the other end of the spectrum. So it's not that one sector is very expensive and one part of the market is very expensive and everything else is relatively cheap. But you find, so we don't have a choice but to probably even try and rotate within the sector itself. So even in something like consumption, we'll find those kind of opportunities. There are some parts of urban consumption-led ideas or stocks which are doing, which while they've demonstrated performance, but the thing is that they're trading at excessive valuations, whereas some of the others which are more, let's say, value-oriented are not doing as well. Same applies in the case of the industrial space as well. So while we like the cycle, but then there are some which are, as even Pankaj mentioned, where we've seen extension of balance sheets and where we probably don't see as much of cash flow, and even they are doing very well. Whereas there are others which are supported by reasonably strong order books and probably will see better growth or outcomes and maybe even surprise in earnings. So I think we are just trying to dissect them within their respective spaces and take decisions accordingly.
Okay. All right, gentlemen, Taher and Pankaj, thank you so much for stopping by. I appreciate your thoughts. And it's important you guys make the point that, despite the rally that we've seen in the mid and small cap space, I think the time has come to become a little cautious as well, because anything and everything is rallying. So you don't want to burn your fingers. That's what history has taught us, right? Thanks a lot for that sane advice.
Can I just say
sure, of course.
just one quick point? Can I ask Anurag, our producer, to pull up that small cap valuation graphic? Pankaj, this is for you. I just want you to very brief response to this. So you put out so much rich data, right? Interesting data, which kind of points to the need for caution. So this is simple valuation data for small caps. Can we have the data up? Yeah, there you go. So let me just read this out to you, Pankaj. So I just looked at small cap, the Nifty small cap index, 1 year forward PE multiple, right? Where it is now as compared to the previous significant highs. As of yesterday's close, the 1 year forward PE multiple is 16.3 times. The last significant high, top, was October of 2021. We were at 23 times. We're at 16.3 times now. Back then, in October 21, we were at 23 times. And before that, the significant peak, the one that you were mentioning earlier, 2017-18, the small cap 1 year forward PE multiple was 14 times. So we are above 2018 levels, but significantly below the October 2021 levels. Just a 30-second response. I mean, how to think about these numbers, Pankaj?
So you are looking at the forward P, Prashant.
Correct.
When I look at the trailing earnings yield, today small caps are trading at a slight premium to large caps. Okay. And the trailing numbers are what it has been reported. Forward is our opinion, right? And in the index, don't forget that there are a lot of companies which are moving from loss to profit. And hence, on the headline basis, it could be slightly misleading. Because unlike large cap index, where there's hardly any loss-making companies, in mid and small caps, there are many loss-making companies, and some companies are moving from loss to profit. And hence, the headline valuations could be a little misleading. We need to go into a little detail rather than looking at the headline valuations, what you have been on a forward basis. That's a caution I would make.
Perfect. Excellent. Makes sense. Thank you. I just wanted your response to that, and that makes so much sense. Thank you very much once again, Pankaj and Taher. Great discussion. Both of you, appreciate your time here on CNBC-TV18. Sonia.
Absolutely. Thanks a lot. So from small caps, let's now move on to talk about the macros of the market. Neelkan Mishra, Chief Economist, Axis Bank and Head of Global Research at Axis Capital, is our guest joining us now. Neelkan, good morning, and always great having you on the channel. Thanks for taking the time out. I want to start with the recent data point that we got on retail inflation, right? It surprised a lot of people negatively with this number coming in at that 7.44%, which is a 15-month high. What was your key reading? How do you think the RBI will move henceforth? And what is your own view on how, the interest rate scenario could pan out given the kind of data that we have?
So the only thing I found interesting in that inflation report was that the core inflation actually declined from 5.2 to 4.9. And that for a policymaker is far more important than where the price of tomatoes is. I mean, you must have seen those YouTube videos where you're starting from a seed, you can grow a tomato plant in 6 weeks. So already some of these prices are down. I think there are valid concerns around India's output of cereals, of rice and wheat, of why retail prices have jumped up. So there are some inflationary concerns given the really volatile monsoon. But as the MPC sets policy, while the mandate is on headline inflation, I think they will be anchored to what's happening to core inflation. And therefore, the necessity to raise rates further, I don't think is there. But if someone was expecting a rate cut in the near future, I think that was ill-advised anyway. I don't think till the time that inflation goes visibly below 4%, the MPC is going to be cutting rates. So we should see the MPC on hold for a sustained period.
So, given that the RBI governor has reiterated his commitment to bring inflation down to below 4%, do you see a lot of non-monetary interventions going ahead?
Well, the RBI can only do monetary intervention, but I guess what you meant was interventions which are not linked to just interest rate changes. So yes, I think the tightening of the liquidity conditions so that the transmission of the rate hikes is much better or faster. And of course, the longer they hold on to higher interest rates, the more the impact on the economy. But on the rate side, I don't see any reason for them to move any further.
So, the Prime Minister has also stressed on fiscal responsibility and his opposition to freebies. So, do you think that do you expect the government to stay the course as far as fiscal prudence is concerned?
One of the reasons why India's prospects have emerged or have become so prominent in the world today among investors, among corporates, and if you read the newspapers, even among the common people abroad, that it is because you can see 3-5 years without any fear of significant volatility. So it is reasonable to expect that the rupee will be, even if it has to depreciate or appreciate, it will be quite stable. Inflation trends, short of these disruptions because of weather, should remain reasonably stable. The interest rate environment, you're not seeing like 200, 300 basis point hikes or fearing such kind of hikes. And I think to a large extent, this is driven by the macroeconomic stability that seems to be the objective of the MPC and the government. And to disrupt that stability, meaning to start going down the path where you are sort of giving freebies to people, it will appear very attractive in the short term and may even boost growth. But then the aftermath of that sugar rush is a very bad hangover, right? So it means higher inflation, it means weakening current account, and therefore then the rupee needs to weaken. You just look at what's happening in the US, right? So because of fiscal indiscipline, now the 10-year bond yields are well above 4%, and the risk-free rate for I think global financial assets need to be marked up from the 2.5% that everyone was used to. So we need to be very cautious on how and why the government is spending. There's one quick point there that as you are trying to bring down your debt to GDP ratio, which is very elevated because the government had to bear a large part of the loss during the COVID shutdowns, you need to bring down the fiscal deficit, but if you bring down too fast, you end up slowing down GDP as well, and that hurts the debt to GDP ratio because the denominator slows down. Now, to do it prudently, what you need to do is spend on things that can affect GDP over a medium term, in the sense that you distribute that money to people, they will consume, there is a short-term impact. If you build a road or a railroad because of that, with that, the impact on the economy is over a 3 to 5 year period. And I think that prudence is one of the reasons why India is being seen as a stable growth economy over the next 3 to 5 years.
Neelkant, hi, good morning. And good to have you, good to be speaking with you here. You know, the Prime Minister in the interview to Money Control has spoken about several aspects of G20, right? And of course, I mean, over the next couple of days, we will see a fair bit of coverage of G20 as we host it in Delhi. From an economic perspective, you know, what are the big advantages of doing it, of hosting it, in terms of new trade opportunities, you know, sort of ability to get in more foreign investment, showcasing ease of doing business? I mean, just your thoughts.
I think all of those points, and remember that in a meeting where you are the chairperson, you can set the agenda. Now there will still be spoilsports who will try to sort of slow the process down or make sure that the final announcements are not 100% to your liking. But you know, when you're looking at global geopolitics, these are moves that happen much faster than, or for a much longer period than what our markets are used to, right? So these are things that are about a slow victory in a clause here, a phrase there, but there is a move forward, right? So India is showing leadership on, for example, if you see some of the changes coming through on the global regulation of crypto assets, on how I'm at least trying to build a consensus around the issue of climate financing. So these are long-term issues. I think to expect a G20 level resolution to start impacting the economy in the very near term is something I think would be unwise.
Would be unwise. Fair enough. Neelkant, you know, the other thing, right, the Prime Minister spoke about shared global prosperity through optimum utilization of resources. What do you believe India is driving for here in terms of global economic cooperation? I mean, nowadays, I mean, the terms which are thrown around quite a bit are, you know, the world moving away from a unipolar world to a multipolar world, trade tensions, etc., between the two big powers, US and China, are perhaps at an all-time high. Of course, I mean, even from a flow investment perspective, India kind of stands out. So just wanted your thoughts there, Neelkant.
So equal sharing of resources means that on a per capita consumption of energy or per capita waste generation, there should be more equalization, right? So today, India's per capita consumption of energy is a fraction of that of the US, for example. And as India becomes more prosperous, and as you know, GDP growth and energy demand are very tightly correlated, we will be consuming a lot more energy. We'll need to consume a lot more energy, and we cannot do it the way the US did it. There needs to be more equality. You can't put burdens on India because India needs to grow now, and the US and the UK have already polluted their way over the last 200 years. So when these things are being discussed, that global resources need to be consumed more evenly, I think these are the most important aspects. There are now with say the growth in in the battery ecosystem, right? So there are critical components which are available only in a few locations. And there has been a gold rush. Basically, some countries have gone and have sort of started controlling those assets. And so as the demand for energy storage, the demand for batteries grows globally, will the sort of control on those specific reserves, will that slow down the rest of the world? Because those are not being shared equally. So I think there are many such issues that will emerge as we go forward.
Neelkant, from a market standpoint, right, the next big event to watch out for is the elections. And in that context, in the run-up to the elections, what is your own expectation? Do you think that this time around there could be a lot of infrastructure spending because, we've seen a big run-up in many of these stocks, Capex related, infrastructure, the ancillary sectors as well. Your own thoughts on how to approach this in the run-up to the elections and what your expectations are?
So we've been very positive construction over the last 2 years, I would say, especially in the last 1.5 years. And this is not just because of the growth in central government spending on national highways and railways, but also the fact that state government capex had been delayed because of pandemic-related restrictions. They could not do work from home. They could not move files fast enough, and so both central and state governments are currently spending very aggressively, and I expect that this should continue for another at least 3 to 5 months. But then we may go into a period of a lull. But for other construction-related inputs like cement, we think that residential real estate construction has started moving up. Even independent home builders are now starting to show some action. So we have seen strong demand growth for tiles, for PVC pipes, for wood material, and this should sustain. So basically, some of the state and central government spending, I think, naturally will slow down as elections approach, because there will be a period of a lull, there will be a code of conduct, and the desire to finish projects, which are, or work on projects which actually could get executed or finished, after the elections would of course be not there. So there will be a bit of a slowdown, I think, but on the construction of commercial real estate, residential real estate, independent home builders, I think that activity will sustain.
So just to summarize, what does all of this mean from a market standpoint? Because it's been a fairly decent run up until now. I mean, the headline index, of course, has seen a single-digit growth, but in the mid-caps, there's almost a 25% return that you've got, since the start of the year. Given that we have elections, there could be more infrastructure spending. The RBI is largely looking to control inflation as well. Do you see many more positive triggers for this market to rally henceforth? And what would your prognosis be?
Actually, I'm quite concerned, and I heard some of the discussion you had with the previous panelists, and I would be tending to agree with the more cautious tone, which is, see, global cost of capital. Remember that our equity markets are not just about domestic flows. While domestic flows, I think, will keep the PE multiple supported, but remember that the global cost of capital, the global risk-free rates have already gone up by 1.5–2% points. So people were used to a 2–2.5%, maybe even a 3% 10-year bond yield in the US. Now we are in the 4–4.5% range. And as this happens, the valuation of all financial assets globally needs to adjust for this. If you remember 2010-11, when some of the consumer companies trading at 40–45 times earnings were considered very expensive. So over the past decade, as the US adopted a tight fiscal, loose monetary policy, the valuation adjustment, because the markets took a while to adjust to the fact that at every instance, monetary policy would be eased. The muscle memory of the market is still stuck there. And therefore, people are starting to talk about, but the P multiples can go higher from here. What is so wrong with 70 times earnings? And that environment, I think, has changed. So as we think about what is a reasonable multiple to pay for a stock, we should keep in mind the changed global macroeconomic environment.
Okay, all right. Well, Mr. Mishra, thanks so much for stopping by and giving us your view. We look forward to having a chat with you in the coming weeks as well. Well, time to move on to some corporate action now. Sarda Energy, well, that stock is on our radar. Remember, the entire metal space has been buzzing of late. This one as well is much higher if you look at it in the last 1 month and even year to date. To understand what's the outlook from here on, we are joined by Mr. Padam Kumar Jain, the Director and Chief Financial Officer at Sarda Energy, who joins us on the show. Hi, Mr. Jain. Good morning. Thanks so much for joining in. Well, a couple of factors. You sell mostly longs, and reports indicate that long prices are up, irrespective of it being a monsoon season. Now, you tell us, in the last 1 month or so, how much higher are long prices, point number one. And the second factor, if you could tell us, is demand really that strong on ground for a monsoon season?
Yeah, very good morning, Nigel. And
Morning.
thanks for inviting us to express our views. Yes, demand has been quite strong in the domestic market, particularly in the long products. If you see the production in last 7 months, India has recorded a growth of 9%. Considering the global level of flat production over 7 months, India's 9% growth itself reflects that there is a very good demand in the domestic market, because exports have not gone up, rather imports have increased as compared to the previous year. So on the ground, demand is very good. And so far as prices are concerned, that demand is also reflected in the improving prices. In last 1.5 months, the prices have improved by about 3,000, 3,500 in the long products.
Got it. All right. So that's pretty good news. The other key, product that you sell is pellet prices. And as of the last quarter, it was around 9,150. But I understand that demand has improved out there as well. And those prices have improved a little bit. Could you tell us what are the current prices? And also, what is the broad range we should look at in terms of pellets for this year? So we're asking your range on pellet prices and your sales volumes as well.
Yeah, so far as pricing is concerned, current price of the pellet is in the range of 10,300 to 10,500 rupees per ton. But in the July and August, the price realizations were a little below 9,000. So average, what we had estimated and we had given in the last discussion, so it should be in the range of 9,500 plus for the quarter.
Got it. All right.
And so far as volumes are concerned, as reported earlier also, last year we had achieved a production of 8 lakhs metric tons, and we have applied for increase in our capacity, and if we get the permission in time, we should be able to produce somewhere about 8.5 lakh tons over the year.
Okay, got that. Since most of your ferro alloys are exported, I just want to understand what is the kind of export demand that you're looking at right now, if you can quantify that for us. And what is the additional sales that you would expect from this third ferroalloys furnace of SMAL that was commenced in Q4 of last year? If you can just help us with some numbers there.
Yeah, so far as export demand is concerned, Europe demand has been sluggish. But in general, overall demand has been reasonable, not very strong demand in the export market. And that was reflected into the lower price realizations in last few months. But now demand has improved, and the price of the ferroalloys has also moved up by about 10% in last 15 days or so.
Okay. So I'm just trying to understand, so for all of this, right, put together, what could the blended margins be for FY24? What kind of margins are you looking at? And in FY23, I think your margins were about 25.2%. Could you do better than that?
Yes, and so far as the production from third furnace, which I forgot to respond, we expect additional production of about 40,000 to 45,000 tons from third ferroalloys furnace, but it also depends. Sometimes it happens, as is the present scenario, sometimes we get very good price realizations in the merchant power market. So that time we prefer to sell the power instead of producing ferroalloys if we find that we are getting a better realization in power sale. So that may have some bearing on the volumes, but overall, if everything goes usual, what we had given the estimate of about 2 lakh tons of the ferroalloys production during the year, we should be able to achieve that production. And blended margin, giving any guideline on the margin will be very difficult, because we are in the commodity market, and if you have seen in the last few months, there has been a huge volatility into the prices. Price was down, then again prices have moved up. So we generally don't prefer to give any guidance on the margins, but things appears to be good in the coming months.
Okay, all right. Mr. Jain, the other part of your business is commoditized, but your hydro power plant, well, that is a business that the street was betting on. And earlier, I think we were factoring around 240, 250 crores odd. Now, this is an important quarter for you, particularly for this hydropower plant. Rainfall has been a little lower. So will it impact that number, or do you think you'll end the year with that 240, 250 crores of EBITDA?
No, so far as the generation till date is concerned, it has been better than the previous year.
Okay.
So we should be able to achieve what we had projected. Our generations, when we compare with the previous year, overall generation is better than the previous year till date.
Okay. So 240, 250 crores is still on.
Yeah. So it should be somewhere in that range.
Okay. All right. The other worry that the street has, or, in fact, it's a hope, the SKS power. Earlier, the resolution was in your favor, but I believe there were a couple of appeals that SKS power should not just go to Sarda Energy, and there were talks that maybe, in fact, this bid will be reopened. Now, we don't know, but we want an update from you. What is the status on SKS power? And, by when do you believe that you will get all the approvals?
No, as you are aware, this matter is before NCLT. NCLT has heard our creditors' petition to grant approval in our favor. Then there were certain petitions from other participants, which has also been heard, and the matter has been reserved for orders. And since the matter is sub judice, I don't think we shall be able to comment what will be the outcome. But as of now, what is there, the process has been quite transparent, and we are quite confident that the decision should come in our favor. There is no reason why decision. Yeah.
When is the next hearing, Mr. Jain?
Yeah, there is no hearing. The matter has already been heard and closed for orders.
When is the verdict then?
Now it is up to the tribunal. We cannot say when they will issue the orders, but no hearing is pending. Matter has already been heard, and other petitions have also been heard, and matter is due for reserved for orders.
Okay, one final question then. Is there any scope to reduce your debt further? The consolidated debt of the company stands at around 700 crores. Any plans to reduce it?
I don't think as of now we have any plans, because now we are going for acquisition of SKS. So at this stage, we don't find any reason, but gradually whatever repayments are due, those have been going gradually, and whatever, if you see the net debt, whatever surplus generation, so that is going down. Gradually it is going down, but repayment, we don't foresee any reason for expediting the scheduled repayments.
Okay, all right, Mr. Jain, thanks so much for stopping by. So the takeaway is that demand is strong on ground. Prices of longs are up between 3 to 3,500 odd. And hydropower plant, the EBITDA will be around 240 to 250 crores odd. Time to slip into a short break. On the other side, we'll have the management of Jupiter Lifeline Hospitals. They'll be joining in to talk about their IPO. Stay with us.
Okay, as promised, we have the management of Jupiter Lifeline Hospitals. Their IPO opens today for subscription. The IPO size, remember, was reduced. It has been reduced to 542 crores versus 615 crores that was planned earlier. The company has already raised 261 crore rupees from 39 anchor investors. And we have Ankit Thakkar, who's the Chief Executive Officer at Jupiter Lifeline Hospitals, who joins us now. They have 3 hospitals that are currently functioning, and they have another one that is under construction as well. So we'll talk more about that. Ankit, thanks a lot for joining us here in the studio, and all the best with your IPO journey. Just want to start by asking you what exactly, will you be doing with the funds? What's the utilization like? Will you use any of it to retire debt? And what is the way forward?
Thank you for having me. So, of the 542 crores that we are raising in primary equity, most of it will go towards debt repayment. We have about 500 odd crores of debt. So, post IPO, we'll be completely debt free.
Okay.
Balance, of course, will be used for some general corporate purposes.
Okay.
The way forward in terms of the growth strategy is that once we become debt free, it will leave more free cash in our hand, and that we plan to use to plow back for further growth of the company.
So, this entire business has picked up in a big way, right? The hospital industry, I guess post-COVID as well. Medical tourism is also back in a big way. Your own occupancies have been pretty steady. I mean, combined occupancies have been at about 63%. Is this a run rate that you can sustain through the course of FY24 and 25? And what would the growth triggers be for you?
Yes, so on the consolidated basis, that has been our occupancy. But if you split it out by units, which are in various phases of maturity, the first one, Thane, which is 15 years old now, has occupancies of above 70% and sustained very well. The second one was Pune, which was 5 years old. End of last year, we were at around 67 odd % of occupancy, and we had an opportunity to add few more beds brownfield in the same asset. So we have undertaken that expansion, brought the occupancy down to mid 50%, giving us a significant headroom for growth in Pune. Similarly, in Indore, which is planned for 430 beds, we are just operating 230 currently at occupancy of 40%. So there's Indore is just getting started and has a long road ahead of itself.
Okay, all right. Hi, Ankit. Good to see you in the studio. Thane is bulk of your business, right? And just going through the note, and it appears there are some PILs against this Thane land out there. Could you give us an update on that? Do you expect things to get cleared out?
Yes, there are actually 3.
Yes.
As a preamble, I think what I want to say is multiple high courts in the country, including the Supreme Court of India, have come down heavily on abuse of PIL as a process. Some litigants have also been imposed costs by the court for abuse of process and malicious PILs. We believe that most of these are kind of in this bracket, and for the 6+ years some of them are filed, the court has not even admitted those PILs.
Okay.
So in our view, they are not very serious, but because they are in court, it is not appropriate to talk too much about it. But this is our general view.
But you want to assure the investors out there there's nothing to worry in terms of business.
That is our assessment and our legal counsel.
We clear that then out of the way.
Absolutely.
A couple of more aspects. Medical tourism, I think it's in mid-single digits for you. But I guess, there is scope to grow out there. So are you looking at that? Point number 1. And point number 2, as a percentage of your total revenues, how much is surgical revenue?
So, to start with medical tourism, it is not a major focus area as far as we are concerned.
Okay.
Our thought is that healthcare should essentially be seen as a hyper-local service.
Okay.
If any one of us were to think about our own selves, if we were to need a hospital, how far are we willing to travel to reach a good hospital? 20-30 minutes, not more than that.
Yeah.
So wherever we are located, we choose locations which are densely populated residential communities and which are relatively underserved in terms of corporate or tertiary healthcare. And those are the locations where we are based. And because of that, there's enough and more of local demand which we aspire to serve. So medical tourism has never been a focus area.
And what about surgical revenues?
So we don't really track too much of medical, surgical, etc. breakups because we believe you have to do what you have to do. The kind of patients who come in and whatever they need. If they need a surgery, they do. If they don't, they don't. So we don't really track that actively as a ratio.
Okay. I think what the street would also like is the fact that this is a high margin business in general for the industry and for your own business as well. You've clocked in, I think, 23% margins in the year gone by. And on an average over the last many years, it's been around 20%. So is there scope to increase margins further in the years to come?
So, to some extent, because the 23% blended margins include the financial results of our Indore hospital, which is just 2 years old and just around EBITDA break-even stage.
Yeah.
So, there is a little bit of dilution effect because of the Indore hospital. Once that matures, and then maybe you could see a little bit of growth in numbers. But mid 20% odd margins are respectable and acceptable in our view.
So mid 20% is something that you can hold on to. Now the reason I'm asking you about margins is because I'm sure you have expansion plans as well to get into new cities, right? You have a plan to expand to 2,500 beds in the next few years in several micro markets. Tell us a little bit about that. And you know, in the first 1 to 2 years, I think the hospital business is not very profitable.
Absolutely.
So would that impact your margins as you go ahead with these expansion plans?
Definitely. So our growth plan, we prefer the greenfield mode of expansion. We like to buy the land, design and build custom built facilities and hospitals, and then operate them. Currently, as we speak, we are constructing a 500-bed hospital in the Dombivli region of Mumbai metropolitan area. That will take around 2 to 3 years to get commissioned. Besides that, we are looking to add a couple of more new hospitals, but we have thought that we would want to limit our growth to the Western Indian region currently.
Right.
So that is a growth plan. As regards the first couple of years, definitely it could take anything between 1 or 2 years to achieve a EBITDA break-even stage.
Yes.
There is no hiding away from that. But as we see where we are, in maybe 2 or 3 years from now, by the time Dombivli comes up, Indore should have matured, Pune and Thane already in advanced stages of maturity. So there will be 3 functioning and mature hospitals to act as shock absorbing capacity for one which will be new, you know. Okay. So as a consolidated level, we don't expect a huge dent in the P&L.
But apart from Dombivli, any others that are planned in the near future?
We are looking to acquire some more lands. Nothing is signed as of now to talk about, but we are looking to add some more facilities in Western India.
And 2,500 beds is the target.
Something like that.
What is the rough capex you will associate with this to scale from your current capacity towards this 2,500?
So for Dombivli, we have planned about 1 crore a bed.
Okay.
Going forward in the next 1 or 2 years, depending on how the inflation pans out, we may have to budget for a slightly higher cost in the newer facilities.
Okay.
But the current hospital that is under construction, 1 crore a bed.
And current capacity is?
1,200 beds.
1,200 beds. So approximately 1,200 crores more.
Yes, something like that.
But you'll have cash flows and you'll be debt free as well.
Correct.
Okay, all right, Ankit, it's good to speak to you. Thanks so much for coming down to our studio. Wishing you all the best with this IPO. And on the listing day, we'll push you a little bit more for some numbers as well. Wishing you all the best.
Thank you so much.
Well, for the time being, though, we'll have to slip into that short break. When you come back, we'll turn our attention to the commodities market. Manisha Gupta will be waiting by.
All right, well, back. Well, let's talk about the commodity markets now. Manisha Gupta is joining in to give us an update on all that she's tracking there. Manisha, good morning.
Thank you for that, Sonia. Well, I'm looking at the sugar prices where we have seen a strong surge continue into the international markets and now in the Indian markets as well. So much so that in last 2 weeks, we have seen the Indian sugar prices gain up by nearly 3%. And with that, we are trading at a 6-year highs now in the Indian markets itself at around 37 rupees per kg, which are ex-mill prices. Well, this is the festival season and we have seen higher quota being allocated to the mills by the government as well. But even with that, the expectation that the global markets will be looking at a deficit and the Indian markets are looking at a lower crop are some of the factors where we have seen support come in for the prices because of. Take a look at the Indian markets first, and we are estimating 3.5 to 3.3% lower crop year on year at around 31.7 million tons. This is what the markets have been factoring in and is the reason that you have seen some curbs continue. And then the lower rains have hit the yields in Maharashtra and Karnataka, and that could lead to lower output going forward. Remember, there also is an estimated 4.5 to 5 million tons going in for ethanol as well. And so the remaining sugar that would be available for us is 31.7 million tons there. Also, when you look at the exports as a picture, this year, the expectation is that you could be looking at lesser export or there could be a halt for the first time in 7 years as well. Last year, we did 6.1 million tons and before that, 11.1 million tons. So we are looking at lower and lower exports in that sense as well. Now the sense in the international markets where we are looking at the prices trading on a higher note as well. So when you look at the New York sugar prices, we are trading at a 4.5-month highs and the London sugar prices are trading at a 12-year highs there. As I said, there are concerns about output there as well. Thailand and Indonesia, the two other major producers and exporters, also are looking at a lower crop. And the US Department of Agriculture has released a report suggesting that this year the global closing stock is 15% lower at around 13-year lows. Another important picture that you could be looking at is the global deficit estimates for 2023-24. Here as well, USDA and International Sugar Organization believe that 2 to 2.2 million tons of a deficit is what the global markets could be looking at. But LVN, and this report came in yesterday, and the reason that you saw such surge in sugar prices is after this report, which suggests that the sugar deficit in the global markets could be as high as 5.4 million tons. And that has been keeping the sugar prices globally and in the Indian markets on the stronger side.
Thanks a lot, Manisha, for that. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Pawan Goyal of Naukri.com and Sunil Chemankoti of TeamLease Digital to discuss the hiring picture across sectors.
Well, India's mid-cap and small-cap companies have literally gone through the roof at all-time highs. On It's the Economy today, we are seeking to check if this market exuberance is supported by some broad-based business growth at the bottom of the corporate pyramid. Nothing proves a company is confident of its business as much as its hiring intent. And I have with me today Pawan Goel, the Chief Business Officer at Naukri.com with their famous Naukri Job Speak Index, and Sunil Chemankotil, the Chief Executive Officer at Team Lease Digital. They also have put out an elaborate survey on hiring intent of companies in the July to December second half of 23. Pawan and Sunil, thank you very much indeed for joining me. Pawan, let me come to you. Your latest Naukri Job Speak Index is indicating hiring intent is higher than it was in August, is higher than July. Can you give us more color? Are companies hiring more?
Yeah. So if, the hiring intent from July to August normally decreases. We see about a 4 to 8% decline historically. But this year, it's a 6% high. So now, but if you take a year-on-year perspective, the job speak is still 6% down from a year-on-year perspective. So the hiring intent was highest last year, driven by great resignation wave. It had slowed down subsequently. And if this July to August month-on-month growth, which is different from the historical trend, sustained, then perhaps the bottom is behind us and we can see a hiring intent growth over the subsequent months.
Okay. Now, your obviously all the numbers that we are running of yours, I just want to remind everyone, is percentage of respondents who have been asked the question. So when you see 73% or 65%, it's percentage of respondents who have answered in the affirmative. But Pawan, with your data, can you judge whether the bottom half, that is, small caps and mid caps, are hiring as much or more than the large fellows?
So I don't have specific numbers between it, but what we have seen is actually small and medium companies, they are hiring more than the large companies. Of course, there are sectoral nuances to it. In banking, large banks are hiring more than the small banks, but on an aggregate level, small to mid caps are hiring a lot more than the large companies. As another evidence, Jaipur, Baroda, Ahmedabad, where there is some of the smaller company activity, there is actually job growth there more than in the metros.
Okay, we will run that city-wise hiring as well. And as Pawan points out, tier 2 cities are hiring a lot more. I think Vadodara is ranking very high over there. That table will come for you in just a minute. Sunil, similar question to you. Overall, is hiring intent better? I think your team leads hiring intent also is showing that for the second half, the hiring intent is 65% versus 62% in Jan to June.
Good morning, Lata, and good morning to all the viewers. Thank you for having me in the show. Yes, Lata, overall, year on year, if I look at there is a 10% increase in the intent to hire. Normally, we see the second half of the year having more consumption because of post-monsoon, and it's a festive season. Most of the shopping, etc., is scheduled for the second half of the year. So we have seen a increased intent to hire across the sectors. Predominantly, if I would say BFSI, we have seen in FMCG, BFSI, telecom, we have seen better intent to hire.
Okay. What's your sense about, again, the bottom of the pyramid and the top companies? I know you specialize in digital jobs in your company, but is there, the Infosys of the world, or is it a large base of, companies? After all, everybody wants technology today. Even banking companies describe themselves as technology companies with a banking license. So is there small and mid companies hiring more than large ones? Sunil?
As per our survey, the bigger are getting bigger. Okay. So the large companies are hiring more. They have more intent to hire, while the medium and small sectors are actually treading this very carefully and are very cautious. If I talk about the digital hiring, which is the tech hiring, there is an intent to hire across the sectors. However, the real conversion in terms of hiring has still not seen the light of the day.
Okay. Sunil, you all also have separate data on age-wise, experience-wise hiring. And there, freshers are being preferred. Is there, for kids coming out of college, are job prospects good?
Yeah, as per our survey, there is entry, junior, middle, and senior level which we analyze. And the entry and junior level hirings are actually the intent to hire them are more than the middle and senior level. Predominantly because of the cost factors, and it's a kind of investment which most of these companies are doing so that they can hire the fresh kids coming out of the college and maybe junior employees, and then train them and kind of mitigate the risk of front loading the cost.
So overwhelming hiring is in the fresher category.
Yes, fresher and junior category.
Okay. Pawan, what is common between the Naukri JobSpeak nuances and the team leads data is IT is hiring less. I wouldn't say not hiring, but clearly the pace is far lower than the first half as well as year ago. Can you tell us who is picking up the slack?
So from a sectoral standpoint, oil and natural gas, real estate, banking, pharma, these are the hospitality. These are the sectors which are really picking up the slack right now. And they're growing on a year-on-year perspective as well as month-on-month.
Okay. What would you say about salaries, Pawan? Are people hiring for salaries as they did last year? I would assume the bottommost salary increases along with inflation. Does it just keep pace? Is it better?
Sure. Now, I just want to give you the Naukri data is not based on intent or survey. It is based on actual actions that the companies are taking and job seekers are taking on our platform, correct? Yes. So what we see in terms of hiring is actually hiring in higher experience brackets as well as higher salary brackets is higher. So 20 lakh plus salary segment, hiring is actually growing right now. In the 3 to 20 lakh segment, hiring is declined year on year, and in the less than 3 lakh segment, the hiring is flat. Now, if you take an experience cut also, the highest hiring that we see on our platform is in the 16 plus year segment, and it starts going down as you go down the segment. Now, from a year-on-year salary growth, last year, because of the great resignation wave, the talent was significantly in demand, and we saw about 20% plus year-on-year salary growth on an average. This year, that number has tapered down dramatically, and it's come down to about 5%. So the hiring slowdown is reflecting in the salary growth as well.
Okay, that's very helpful, and that also to some extent ties in with people who talk about K-shaped recoveries. Those who are earning well are now getting more jobs and can earn better. That message is clearly coming from the recent trends in Naukri JobSpeak. And yes, all your data is flashing on the screen. Please note, Naukri is actual hiring activity, and the team lead survey is hiring intent activity. Please note that difference. We are covering it both ways. Sunil, what's your sense? Even your data is proving Bangalore is hired less, although still the highest hiring city, is hired less than it did in the previous 6 months. So clearly IT is impacted. But if IT is impacted, who is picking up the slack?
So if you look at our data, all the IT hubs, there is a slowdown in the overall hiring intent, even for the services segment. And that isn't that reflective of the mood of the employee base. They are spending less, and the slack is being taken over by, as my other panelists said, that there's a lot of oil and gas. Manufacturing is also picking up. If I look at the sector wise, the intent, the healthcare is doing well, telecom is doing well. FMCG is picking up some. In terms of moderate level, I can see media.
Pawan, sorry, Sunil, I want to know, since you specialize in digital in your company, is a large amount of hiring happening by the GCCs. So even if the, technically IT companies like the TCS, Infosys, etc. are not at the best of hiring spree, is it picked up by, the Deloittes and a whole host of GCCs, special GCCs?
That's an interesting question. See, while there is a large understanding that GCCs are expanding in India and there is hiring happening there, but if you look at the volume of hiring by the GCCs is not comparable with the IT services, because IT services hire in large volumes. However, the difference what we are seeing this time, the GCCs which are setting up base, is they are just not hiring the tech talent. They are also hiring a host of functions like the finance, HR, marketing, and all other sectors. So we are seeing in GCCs that hiring is picking up, and that's a good sign because the GCCs are broad-based now. It's just not the tech GCCs which are coming up. And there is some hiring happening. And if you look at the GCCs which are setting up, Hyderabad and Bangalore predominantly have the largest share for all the new GCCs which are setting up. Again, the big fours and the consulting companies also, professionals like lawyers, the finance, chartered accountants, etc. are getting hired in big numbers. And that's where the difference between last year to this year.
Got that point. Actually, we just had a guest, Neelkant Mishra of Axis, who was making the similar point, and I think he has written in one of the newspapers that Indian talent is now not IT as much as middle office, which includes audit, law, compliance. That whole middle office has moved to India, or is moving in many places because of work from home or remote working. Pawan, an overall question to you. Your Naukri index starts in 2008 with an index of 1,000. And today stands at, 2,666. It looks, after all, you all cover only the formal sector. It's sort of huge. It's the index has just doubled and a bit in a matter of 15 years. Formal sector growth is not growing too much, looks like.
So I was doing the CAGR calculation, and this amounts to about 6 to 7% CAGR for a 15-year period. So that's the growth, whether it's good, bad, I think we can all point of view. But 6 to 7% formal growth, is what we see right now.
Okay. No, actually, it's not a bad. It's more than kept pace with real GDP growth, isn't it? After all, in the 2010s, our GDP growth was also between 6 and 7%. So I guess it's kept pace. Just that final question to you also, Sunil. Overall, would you say that if you looked at a 10-year period, India Inc. is hiring more? What is the pace of growth, you think?
Definitely, India Inc. is hiring more, including the formalization is taking place, while the growth is very slow. But if you look at overall, from 26%, it has gone to 28%. We still have close to 72% in the informal sector. The formal sector is improving, increasing because of government initiatives, but it's kind of slow. And I'm sure that in the coming years we will see further propulsion in the formal sector.
Okay, thank you very much, Sunil and Pawan, for giving us a many-sided, actually, a complete 360-degree perspective on hiring in India Inc. Hiring is good, but it is not gangbusters. It has been growing at a CAGR of 6%. Over last year, over this year, August actually has seen a slightly lower decline, but a lower pace of growth of jobs. But overall, the formal sector is crawling up, and that's a positive. Wrap up on Bazaar on that extremely positive note. Chartbusters up next.